All right, folks, welcome back. This is our Tuesday, October 12th, 2021 commentary for the ICT Mentorship. All right, so everything's going along to script here. Dollar index daily chart. Now, I'm going to kind of like go through this a little bit quicker than I normally do. I like to get into long discussions like I did last night. So I'm going to try to avoid doing that tonight. I gave you a really long one for those that were able to endure it. So short and sweet on the dollar index. We had our run on the short-term high here, so that buy-side liquidity has been tapped into. And we're looking for continuation to see if we can get a run above here. Okay. So again, study what we've seen in terms of coming back down to this old high. And then the order block traded to, and the volume imbalance. And then the outside day with a down close, as I mentioned on Friday. And then we have 2 days of buy-side delivered on to a buy-side liquidity pool. So we're looking for a run into the 94.75, 94.80, maybe even a blow off into 95 big figure. Hourly chart, dollar index. I mentioned the bullish breaker. We've seen continuation of that. Small little buy-side imbalance, sell-side inefficiency. We came down into that. Notice we left this high. Buy-side was building above that. So in other words, resistance from a retail perspective. It comes back down to a discount, imbalance, order block, optimal trade entry, then sends it to buy-side liquidity above these relative equal highs, and the high I was pointing to yesterday as the short-term objective, but we still have some opportunity to rally a little bit higher, I think. And the 15-minute time frame on the dollar index. There's that imbalance. And then we have this candle's wick right in here. Consequent encouragement of that. Perfect delivery on the low. I'll let you test that on your own. So outside the imbalance, how far can it go? Well, you have a discounter right here. Reaches right into that. But notice the bulk of the volume depicted by the bodies of the candle. They're kept inside of the imbalance. Then the premium high on the hourly imbalance. Extend that out in time and get the support found there. Look at that. This is beautiful. Rallies. Short-term run into the old high. Another short-term run into the old high. Relative equal highs. Sends it up into it there. So I'm not suggesting that this is topping. We're not trying to pick the top now. It's important you bear that in mind. But we're looking for continuation on the upside for dollar index and lower on foreign currency. Brings us into the euro dollar daily chart. So we had the imbalance filled in, as I mentioned. We had one more attack on that area in here. Today we went down below the short-term low here, and again, this feels like it wants to gravitate to that 115 and or lower. I'm favoring the consequent encroachment level, so I'm looking for that personally as my own downside objective. But should it get overzealous and animated on the downside, we could see a 114.67, and that would be perfect. It would be a wonderful thing to see, but I'm not really requiring that. About midpoint, which is consequent encroachment. Hourly chart, euro dollar. Small little imbalance here. You'll see that on the 15-minute time frame. I apologize. I should have been toggled to show only on the 15-minute time frame. But when we're dealing with the videos, once it's done, it's done. I don't go in and edit anything. So we have the market return back up into a short-term premium, and then breaks lower. So we have optimal trade entry. The imbalance in here trades into that, leaves a small little portion open. So that kind of like helps depict that, but these levels here are not showing a gap. They're showing the smaller fair value gap you'll see on the 15-minute time frame. Trust me, it'll make sense when we drop down in a lower time frame. It breaks lower, order block, fair value gap, trades up into it one more time with an old low, and then sends it one more time into the sell side liquidity pool, which I mentioned yesterday was low resistance liquidity run signatures. Your $1.15 time frame. There's that small little fair value gap. So it trades up into that on the basis of a Judas swing. Breaks lower, so there's your signature. We see it wanting to drop. Okay, short-term low, broken. Market structure is now shifted to bearish. Imbalance, order block. Trades up into order block low. Breaks lower, small little area in here that, if you look at this area here on a 5-minute chart, it'll be more meaningful to you. I don't have a chart for 5 minutes, but I'll just count you to go in and look at that. It'll be more detailed for you. Breaks again, small little imbalance there. Once, twice, bearish order block, fair value gap, optimal trade entry, New York session, sell side liquidity, breaks aggressively, consolidates one more time into the imbalance, breaks lower, small little fair value gap, comes in, fills that, and then aggressive run in, taking sell side here, and below that old low here. And then there's a small little imbalance here. Price should go up into that, hit that, and we might see another level of selling there. Again, looking at that 115 big figure as a draw on liquidity on the downside. All right, so we have the pound dollar daily chart. And as I mentioned, I wanted to see this consolidate, and it's consolidating in here. I think that if we continue moving higher on dollar index, I think this will bend the knee eventually and sell off. But it's been following the script I've outlined for you all here in looking for consolidation, because it's already ran out its sell side liquidity pools. So that's one of the reasons why I've been looking for this pair to be consolidated, and also because of euro pound being bearish. Doing the standard breakdown of cross pair manipulation, looking for lower prices in euro, consolidation in cable. We'll refer to that in a little bit when we do the homework assignment for pound yen. Hourly chart. Again, the imbalance over here. Trade up into that. Breaks lower. Mean threshold. Bearish order block. And breaker. Hammers it right there. And we'll see that on the 15-minute time frame. Then, now we have relative equal lows in here, and low resistance liquidity run signatures there. If we get continuation on the dollar, I think we'll eventually melt over and attack this area here. And there's that breaker I mentioned in the hourly chart. You can see it much cleaner. I mentioned it actually in commentary yesterday, framing that out, showing the bodies, showing the respect of that, but then reaching up into this small premium array there. And then all the way back over here, referring back to the breaker, cutting through all this. You would never come to that conclusion there with supply and demand. That's why I laugh at everybody that thinks because I have a rectangle on there, they think that an order block is a supply or demand zone. It's not. They would never refer back to this area here. It would never happen. It's not in Sam's description, and anybody else that's his disciple would never refer to that there. And they don't know what they're doing. So the market trades up into the bearish breaker, creates the high of the day, and then trades back down. Doesn't get below the low here, which I kind of felt was likely to occur, but didn't do it. Small little imbalance there. It trades right back up into that. I think that's actually really interesting to see how it does that. And now we're back into consolidation. So this whole business here just lends well to the pound yen pair trading, as we'll outline here now. All right, your homework assignment was the British pound versus Japanese yen. I got a lot of folks asking, could I talk about yen, even though you all know I hate that particular market. But I counsel you to look at this low to this high. Now, folks, listen. I know I sound like a broken record to everyone else that just goes along with the program here, and they benefit from doing it. But if you don't pause the video and go do this breakdown here, what makes this low to this high a favorable price swing, why would we expect this move here? if you haven't done it and broke it down on your own charts, don't watch the rest of the video. Last warning. All right, so British pound versus Japanese yen. We're going to talk about cross-pair manipulation because this is a cross, not a dollar cross, but in my mind, it's an exotic. So I don't want to just jump into this pair and think, okay, well, it's just a matter of, going back down into an old support level, which we don't trade like that anyway. But the idea is we need to break the market down in several stages. Now, before I get into any of this, I want you to remember what I've been telling you as in response to what the dollar index has been posting in its charts. We've been holding a bullish stance on dollar. I've told you that I wanted to see British pound versus US dollar remain in consolidation. And you understand why I told you that because of the euro pound cross. And I went through that whole business last week explaining it to you. I think it was on the midweek review. Now I'm going to do similar fashion with pound yen. So we're going to go into cross-pair manipulation. And when we look at the pair name, okay, like this British pound, that's kind of like the numerator, and Japanese yen's like the denominator. So for cross-pair manipulation, if N, numerator, the first name in the pair, D, the denominator, I'm trying to make it real simple, folks. Okay, so numerator, first name of the pair, denominator, second name in the pair. If it is a buy model, how do you know it's in a buy model? Well, first and foremost, the dollar index, you need to consult that. Are we bullish or are we bearish? And or are we in consolidation? So dollar index is really in consolidation, but with a modest bullish stance. So that means foreign currency should be going lower in respect to a higher dollar, but on a limited capacity. Why? Because the crosses are being manipulated, as I've been explaining with the euro pound. So if that's the case, we're seeing that the dollar index is not in a trending model, but it's in a consolidation with a slightly bullish stance. This is the reason why I tell you being mentored by me is important. It's not just, oh, here's my videos, watch them, and you're going to know exactly what I know. It's going to require you to think. And it requires a lot of thought, note-taking, and experience. So everything I'm going to outline here, you've been taught already. So your homework assignment should be very close to what I'm going to show you here. Maybe not. It's obviously not dressing up a whole lot of the move between this low and this high. I'm not going to go through all the details. But the homework was, why was this 4-hour chart framework bullish? And what was the reasons as to why that would be a good objective to seek being a buyer here and reaching up into this level here. The numerator of the pair, that currency, you need to determine if it's bullish or bearish. Now, obviously, we're looking at this low to high. So this pair was in a buy model. Do not be discouraged or thrown off because we're looking at it in hindsight. This obviously was in a bullish protraction. But what makes it that? This is how you go and understand the logic of how these algorithms work together when they're manipulating the crosses. The numerator equals bullish protraction. In other words, British pound, if it's bullish and it's rallying, that's bullish protraction. While the denominator, which is the second name of the pair here, is held in consolidation. We need to see the individual price action of pound and yen. Not from the perspective of a Forex pair, but we're going to revert back to the futures market. And we're going to strip it down to its barest price action. Or the numerator, first pair in the name, is held in consolidation, while the denominator, second name of the pair, is in bullish protraction. So in layman's terms, it's what makes a cross equal a buy model when it's bullish, something like this here. One of two things happens. Either the first currency in the pair's name is in a bullish protraction, in other words, bullish, you're expecting it to go higher, not in consolidation, while the second name in the pair is held in consolidation. We need to see, does the pound have this signature here, or does it have this signature here? It's one or the other, okay? So with that idea, let's go into the individual markets. So I mentioned as we were approaching the fall months, about second week in September going into October, November, and some of December, these months are much more liquid, and there's a rush to get a lot of commerce into the marketplace, a lot of transactions come in, a lot of mergers and acquisitions, and year-end business deals, purchases, insurance premiums paid, all these things come in, and it creates liquidity. Mad dash to square position sometimes will cause liquidity, and or assuming new positions for those that are a little bit more risk tolerant ahead of the new year that would be beginning. Long story short, the fall months are just a wonderful area to see volatility, and the price action is much more cleaner versus what we see in the doldrums of summer. So with that said, and it's not something new here, you know that we've been anticipating better price action when we got into September, now we're in October. So if we go into the pound, and this is the website you can go to get this information, global-rates.com, and then everything here. All right, the British interest rate for Bank of England. The interest rate right now, the Japanese interest rate down here. So which of these two countries have the higher interest rate? Bank of England. So from a fundamental stance, you have the better interest rate on pound, the lesser of the two in yen. So fundamentally speaking, it's better to own pound versus owning yen because the yield is better received in the pound. So if you're putting your money in the marketplace and parking it, it's better to do so in the pound, fundamentally speaking. It doesn't mean that there won't be drops in the marketplace. I'm just starting here at the baseline that from an interest rate differential stance, pound is better at the interest rate level during a time of the year when the interest rate differentials will mean much more because you have an influx of volatility, order flow, and just general global commerce. So with these factors in mind, we have a real fundamental driver behind the scenes that suggests that we are in the fall months, there's more volatility. We know that dollar's in a consolidation, but with modest bullishness. So that means foreign currencies should be declining. So that might throw you off if you've not been paying attention or doing the previous studies, teachings and lectures I've done on cross-pair manipulation, like last Wednesday's video. This might be a little confusing because you're thinking, okay, well, if the dollar is bullish, even if it is modestly bullish, why is pound yen going up? Because you have an exotic. One of these currencies is going to be more bullish than the other, and one currency is going to be more bearish than the other. And the idea is you start here at the interest rate differential. So now we know that pound is better fundamentally, or more apt to be held bullish and held as a place to park the money for a short period of time versus yen. So funds would flow out of yen into pound. That's kind of like the easiest way to say it. Now, looking at the individual commodity markets, these are the futures markets for the respective currencies. On the left-hand side, we have the British pound futures contract for December. And the way you would pull this up is number 6, letter B, letter Z, 2021. And that's what you would get with this chart here. You may not be able to do the split screen. I think you have to pay for a membership to do that, but you don't need to do this, see it side by side. You can do it by putting in one chart at a time. And to pull up Japanese yen, it's number 6, J, Z, 2021, and you'll get this respective chart as well. And again, these are the daily charts, and these are futures markets. They're not Forex, and it's not the cash price. So it's an individual futures market. And what I'm showing you here, on a daily basis, we see that this high here, we see pound did trade up higher, broke that, and went lower. So there's an underlying weakness expected in here for foreign currency during the time when what? We've been bullish on dollar. So this is true. Higher dollar, weaker foreign currency. And we see the same thing generally with the yen. We see lower prices on yen when we've been expecting what? Higher prices in dollar. So now let's peel this onion back a little bit, layer upon layer. Get inside the details, okay? Notice what's happening here on the pound. We have these lows and a small little retracement here, and then it attacks aggressively below those relative equal lows. Lots of liquidity resting below there. So the algorithm reprices lower, attacking that liquidity, and then pulls up deeper into this imbalance. Once it does this, recall what was being explained to you in regards to euro pound. I said I wanted to see this pair go into consolidation because of the information I taught regarding euro pound. So it's not just simply when you go into these crosses, there's a whole lot more work to do. Remember, you're looking at this pair's root currencies. The individual British pound on the left and the Japanese yen on the right. But I'm talking to you about euro pound because it's factored into why this pair is doing what it's doing here. Think about how much analysis has to be done, and you just think, well, I'm just going to do the guppy, which is the little nickname for pound yen. And then you wonder why sometimes you get your head handed to you on a platter. Because you aren't doing the full analysis. You have to go through several market breakdowns to get a real clear depiction of what's going on, which is the reason why I try to steer you away from it. But you've been trained how to do this. I've taught you, and this is another lesson for it. And also, I get questions all the time, new people in the final mentorship we just took in at the beginning of the year in 2021. Why do I not trade these pairs? Because the tax treatment in the U.S. favors pairs that are traded against the dollar index. So that's why. Also, I'm showing you that you don't need these big moves to find sustainable income in pips, in continuity, consistency, longevity. If you can find it in the low hanging fruit, once in a while you might get fate on your side and you'll catch a big move if you want to dabble into these crosses. But I teach you how I interpret and engage. I have trained you how to see these pairs if you want to trade them. And now let's dig in a little bit deeper. Notice that these respective highs here, we don't see that higher high on Japanese yen. Notice that? So what's actually occurring here between the pound futures and the yen futures? Which one's weaker? Is it this one? Because it went higher and rejected it and went lower as a result? Or is it this one here that couldn't even muster the energy to price above this high here? That's the first clue. This is underlying weakness. This is just a stop hunt. This is indicating from a central bank level to all interbank traders that look for these things, this is the currency you want to be focusing on for shorts. So now, look what we've already done. Now, I'm not making it sound like it was immediate and real short, but in respect to how I usually talk about things, I took you the short way around it. I showed you, fundamentally speaking, pound has the better differential from an interest rate perspective. Yen is basically no reason to hold a yen. Not much more to hold pound, but 0.25% is better than 0%, right? So if we're looking at the yen on the technical side, on the daily chart, we can see underlying weakness in yen versus pound. So we have two things right away that we can filter through going through our crosses. How do we look in the pairs ICT and figure out which one we should be buying or selling? Which is the better? Because I'm showing you pound yen, but the additional study for your own edification, I'm not going to review it for you. Pound yen performed better than euro yen. And what I'm going to show you here, it's easy to see why. There was better movement on the upside for pound yen than that of euro yen. Because euro went lower, we've been expecting it to go lower, where I called pound to be in consolidation. And we're seeing that right in here. This is all the consolidation right there. And go back and listen to the last couple discussions and lectures about euro pound being the factor in this whole business, why I said it should go into consolidation. And what actually helped me have that understanding is by looking at the relationships I'm showing you in this video here. Yen being underlyingly weak, while British pound coupled together with this for euro yen, because we're in cross season. This is when the crosses are going to be moving, because we're in small consolidation, while relatively bullish, near term for dollar, but we're not in a trending model for dollar. So even in consolidations and trading ranges, the market's going to go up and down to some degree, right? That's the consolidation. It's not going straight sideways. So the ebb and flow in these small little ranges, when it's moving higher for dollar, the underlying weakness should be seen in the foreign currency market. We see that, but then we have to go one step further, because that consolidation model that's being implemented across the board through dollar is going to force us to look at crosses, because that's where the big moves are going to happen. Now, some of you that have not been paying attention to them rushing through the content are going to swear that you've never heard me say that. And that's what's going to happen when you go through the lessons again, and you're going to hear me saying these things years ago in recordings that I have not touched up, haven't changed them, haven't augmented them in any way. This is the logic behind it. So we have underlying weakness in yen while we expect consolidation in pound. You see how quickly this can be complicated for someone that just wants to come in and watch 10 minutes and show me how to make money. And they walk away, oh, this is ridiculous. He overcomplicates it. No, it requires this much to understand what it is that's going on behind the scenes. If you're not willing to do this, then you're gambling trading these types of pairs, period. So if we're expected to be weaker in yen, sell side's below here, so it trades down, trades below it. We have a volume imbalance and a real gap between these two wicks and tails, okay? The market trades through it, comes right back up, rebalances there. Why does it do that? Why does it go right to that level here and stop and turn around and go the other way? Well, what's missing? Buy side. They did not deliver buy side between where this candle closed in its high and where it opened on this candle and when its low formed here. There's missing market activity there. On what delivery? Down or up? In other words, was there a body from a candle offered up or down in between there? Neither. It's a gap. But what was the delivery model at the time? It was moving higher. So what's really missing here, right? The buy side. We get the sell side here on this candle where it trades down and it moves away from it. Is that balanced once it trades through that? No. Algorithmically, the algorithm will need to go back up through that area here, and here. And offer up movement, buy side. This is sell side. So it's only half balanced, if there's such a thing. Then the market trades with one bullish candle up, offering what? The buy side delivery. Gap, sell side. What's missing? Buy side. Boom. Short sells off. This is the weaker of the two between pound and yen. Look at the delivery on October, bullish on pound, and then into consolidation, like I mentioned, because of our normal commentary for euro and pound versus dollar. October here, it's just, there's that high that rebalances the gap and volume imbalance, and sell side, now buy side, boom, tanks. See that? Now let's take it one step further. Here's the 4 hour. Here's the pound moving higher. Respectively, what do we see in the yen? It's confirming underlying weakness. Yen is unable to make higher highs, while pound just keeps going higher, higher, higher. It's not going higher for a buy. It's not selling off for a short. It's doing exactly what I outlined in the normal commentaries before we got into the discussion about pound yen. It's consolidating, while this is being allowed to free fall. This little movement here, displacement, trades right back up into the order block, right here, extended out in time, hammers it, optimal trade entry, rebalances the sell side, then off to the races we go. Where does it trade up to for this area here? You go out to your daily chart. We have a nice swing high here, all the way down to that low. Get your measurement from fib high to low. Split that. It's equilibrium. Above that would be what? We have this high here. That's a target. But what's over here? Relative equal highs. Yes. And if it's going to go above that, how far can it go? Keep going over here. What do you have? The bearish order block. Now, I think it could potentially trade further and attack this later on and maybe into here. But for now, the model was, just for this homework and case study, was there's your premium array relative to this low and this high. Why am I using this high and that low? I know some of you are just thinking that. Man, this guy's in my head. All right, so this movement from here down, it starts after the rebalance of this move here. In other words, we have the high, it consolidates a little bit, and then breaks. There's your displacement. It rebalances that, and then the real sudden move begins on this swing high, and then takes a dive into here. That's the lowest in this whole fractal. The fractal is the portion of market action that you're studying at the time. Fractals are up to you to define. Otherwise, this is a whole bunch of candlesticks. This is the fractal I'm taking your attention into, from this high to that low. The real significant price move is from here to here. Ideally, yes, you would love to be a short here, but this is where you would be most likely shorting. And this low, that's your dealing range. So between these two price points here and here, that's your dealing range. So you run your fib on it to determine where the midpoint is. Equilibrium. So if you're bullish here, hypothetically speaking, you're thinking it's going to go higher. So to what premium array? Old highs, relative equal highs, bearish order block, rejection block, buy side liquidity, rejection block, old high. Okay. We also have this bearish order block that it's dug into, and that might be enough of a contributing factor to say, okay, that's enough for me. So that's why I'm framing this low to that high, teaching not to anticipate perfect execution of entry and exit, because that's not practical for you as a developing student. You'll grow into wherever your strengths are, and you'll determine what they are over time. I can't tell you what your strengths are going to be, just like I can't tell you where your weaknesses are going to be. It's your job to identify them, and once you identify them, you work on patching them up and not filling yourself up with toxic thoughts about how you need it to be fixed right away. No, you need to grow into that model and appreciate the experience that's required for it. It's not, I'm going to watch this video and I'm going to understand what he's saying and I'm going to implement it because I watched it and I listened and I may have wrote down verbatim some of the things he said. That's not the equivalent of going in and studying and backtesting and breaking down these moves. That's what I'm showing you. I'm showing you exactly how, if I was sitting down with a book and say, okay, I'm going to go in and teach this stuff. Well, in a book, you're forced to do what? Use hindsight. There's no way I can write a book and anyone else can write a book and talk about something before it happens. That's outside the scope of the medium being implemented for teaching. So that's why I teach you every single day, where I tell you where I think the market's going to go, why it should behave the way it should behave. That's mastery. That's what you know when you understand what these algorithms are going to do. Nobody else is doing that. Okay. They're only talking about after the fact. Okay. But I have to teach you these ideas to force you in to old moves, because a lot of you don't want to do it, but yet you send me emails. I just don't understand. I needed to do this and it didn't do that. And why can't I see this and why can't? Because you're not doing these types of things. And I'm showing you how you can just go right into old data, strip it down, and figure out what I'm teaching you conceptually, how this all plugs in. And over time, how much time? I don't know. Some of you, it'll be quicker than others. Others will obviously require much more time. And there's nothing wrong with that, because you are in a community that's ongoing. I'm telling you what I think is going to happen. I'm navigating the markets with you. I'm holding you by the hand. That's mentorship. But it's your job to go into old moves and strip them down. Because if you just use the examples I give you in the core content lessons or in the commentaries, you're really selling yourself short. There's so much more for you to learn and increase in your understanding if you go into these markets and pick out moves and then break them down. Back test and strip them down from the things I teach you. Not retail logic, the things I taught you. And you'll see, oh yeah, there it is. Now, when you log your observations, your subconscious remembers that, because you're going to feel great about what you're able to see, even though it's in hindsight. Everybody learns from hindsight. Everybody. I learned from hindsight. I got to where I am in my understanding because of hindsight, and then losing money and saying, okay, well, I'm not ready to do this yet. Let me go back into paper trading, because we didn't have demo accounts when I first started. It was writing things down on a piece of paper. I'm hypothetically saying I want to be buying here. Hypothetically, my stop would be here. And hypothetically, I would be trying to get out at this level. And it makes it harder. You have much more resources that help you. And it's more of an instant feedback and an organizational advantage that people like me, as a dinosaur, we didn't have that. We had to do everything on paper, and it sucked. It was a lot of work. And that's why it was important for you to pick one market or two at most, because there's a whole lot of legwork to go into understanding what it is you're learning how to do. And once you understand that skill set with one investment vehicle or asset class, obviously you can apply it to however many you want to do, but you have to understand what you're looking for. And you want to narrow your focus in on one or two markets, which is exactly the reason why I focus all of your attention into euro and cable with the dollar index. As much as some of you have kicked and screamed and complained over the years, please, can we do this? Can we do that? No. I have new students coming in here all the time. Not now, obviously, but up until this year. And it's important for them to have this limited perspective on markets that you're going to see that you will eventually gravitate to one special market. You're going to be a specialist. None of you are going to really just say, I'm going to be a basket trader where I go in and I trade 12 different pairs and I'm always doing something. You may have that in one of your models, but you're not going to be active in that. Like, you're going to basically pick a particular market and just go after that one. That's the one you're going to be a savage in. And I'm not saying you're going to make lots of money, but that's where the majority of your time is going to be spent, in that one particular asset class, in a particular market. And that's ideal, because you'll know what you're looking for. And if it's not there, guess what you're going to do? Nothing. And you're not going to feel stupid. You're not going to feel rushed or impatient about it because you know that market. You know your model. You know what you're looking for. And you don't care what anybody else is doing because you're not on social media worshiping. All right. Today's homework assignment for our midweek review. So we'll be teaching a little bit about cocoa futures. So your homework assignment is the 4-hour chart on cocoa from this low to that high. What makes that a good buy? Why did it react that way? What was the catalyst for this being a high probability low? And why is this a good area for it to trade to as an upside objective? The way you get this symbol in TradingView is the letter C, the letter C, letter Z, 2021 on the 4-hour chart. This is what you're going to be looking for, okay? And with that, I will touch base with you tomorrow. Until I talk to you then, be safe.